Good afternoon, everyone. I see we have our attendees flowing in as we speak, so I'm just going to give us a few moments for everyone to get logged in, and then we'll begin. The pace of joins is slowing, so I'm just going to give us one more moment to let any stragglers join the call, and then we'll kick things off because we don't want to get behind schedule right off the bat. Okay, well, hello everyone. Welcome to Meridian Compensation Partners Fall 2021 Client Briefing. My name is Andrew Conradi. I'm a senior consultant with Meridian, and I'm going to be your host for today's session. We have been so glad to see some familiar names here on our attendee list once again, as well as some new folks who may be joining us for the first time. So first off the bat, thank you all for joining and being with us here today. We recognize that your time is valuable and you're likely in demand elsewhere. So with that in mind, we want to make the most of the 90 minutes that we do have together, and we have aimed to focus this session on a few key of the moment issues that committees are contending with right now. It's no surprise that COVID-19 still looms large, but now with the benefit of at least some degree of hindsight, 2020 disclosures having by and large arrived, we have had an opportunity to review not just how committees were approaching the issue and what actions were being considered, but now also to look at how companies chose to present their decisions and how those rationales are being received by the market. At this stage, although much as I would love to, obviously I'm not here to declare that we're out of the woods and everything has returned to normal in the world. We can start to think beyond the immediate question of what's to be done about COVID impacts, as we were, of course, more focused on when we were together this time last year, and start to look at what lessons we can take from the experience and how and to what extent the decisions made in response to COVID may now be interacting with other trends like the rise in ESG. Of course, much of this remains to be seen, and we certainly think it'll be interesting to wait and to watch and see how the interplay between these different factors unfolds in the coming years. But for our purposes today, and for organizational purposes today, I should say, and try to keep ourselves on track, we've divided the discussion into four broad pillars. First up, my colleagues Matt Cito and Rachel Lee, both senior consultants at Meridian, will be taking us through a high-level market practice update covering trends in compensation design and including a recap of the Say on Pay developments this year and some themes that we've observed around practices we think may have contributed to negative vote recommendations from the proxy advisors where those were at issue, and to the handful of Say on Pay failures that did occur this year on both sides of the border. Next up, Andrew Stansel, a lead consultant with Meridian, is going to be discussing resilient incentive designs, which, as per the title of our talk today, is really at the core of our presentation. For better or for worse, pay programs have been through the ringer and passed through an incredible stress test over the last 18 months. Andrew is going to share some key insights and best practices to consider, along with some design features that we think may help a plan more effectively weather the storm when unexpected events like these do come to pass, and let committees navigate those challenging waters as smoothly as possible, to carry on my nautical analogy. Afterwards, Andrew McElhern, one of the Toronto-based partners with Meridian, will be joined again by Matt Cito to take us through an overview of the rapidly emerging practice of ESG measurements, and in particular the practice of paying for ESG, to highlight how increasing expectations and rising attention from everyone from institutional investors, regulators, insiders, and at this stage, even the public at large, are contributing to this growing practice of not just tracking and not just disclosing your organization's performance against environmental, social, or governance measures, but also treating these as directly compensable metrics in some cases with real with real impact on executive pay outcomes. Finally, to round out today's session, I suspect everyone in our audience on this call has firsthand experience with the reality and perhaps sometimes the harsh reality that no matter how careful and thoughtful we are in setting up our pay designs and endeavoring to perfectly complement our strategy, account for every possible eventuality, we inevitably sometimes find ourselves facing a particular set of circumstances where the unexpected has happened and events just call for a special approach, departing from the usual plan to let us take the most prudent course of action for the business. So while Andrew Stantle is going to be giving us some helpful guidance on designing resilient plans, Chris Medland, a partner with Meridian and the head of our Canadian practice, is going to be discussing special designs for unusual circumstances, when they may be necessary, how best to approach the process if you should find yourself in a situation where your pre-designed and no doubt highly resilient plan is just not able to provide the level of flexibility the board needs to do the right thing. Of course, at the end, we'll reserve some time for Q&A. Please do feel free to submit your questions throughout the meeting using the Q&A button at the bottom of your screen. There is an option to do that anonymously if you prefer, although if you attach your name and we're unable to get to your question within the time available, we would, of course, be happy to follow up with you afterwards. With all that being said, since we do have a rather full agenda this morning, without any further ado from me, I'm going to turn things over to our first speakers, Matt Cito and Rachel Lee. Take it away, Rachel and Matt.
Great, thanks, Andrew. And good morning, everyone. Thank you for joining today. I'd like to start us off with a quick market update of design trends in response to the current economic environment. While many committees were busy last year trying to stay on top of changes to incentive plan targets and understanding where and when to use discretion, 2021 has provided for somewhat better visibility into the economic recovery. So if the theme of 2020 was staying on top of change, 2021 was a year of trying to get ahead of uncertainty. We saw this in a few ways, most notably, next slide, please. Committees considered widening the ranges around targets to achieve a payout. So setting a lower requirement for a threshold payout, but a correspondingly more challenging requirement for a maximum payout, as well as the inclusion of more non-financial metrics like strategic objectives and ESG. Next page, please. On the long-term incentive front, we saw more limited appetite to change plan design in response to the economic uncertainty. 2021 grants were generally within 10 percentage points of 2020 LTI values. The inclusion of new financial metrics or a shift to more time-based RSUs in the overall LTI mix were the most common approaches. Next page, please. We continue to see a decline in option use in both Canada and the United States, with a steeper decline observed in Canada this year. This should be unsurprising to many given the changes in the Canadian taxation of stock options, which came into effect this summer. I should also note that the average weighting in Canadian LTI plans has come down by about 7 percentage points in the last 2 years, also in response to the lower after-tax value delivered to executives. We expect both the prevalence and the weight of options to more closely mirror US practice, where options do not have favorable tax treatment. One thing I'll reiterate is that market data is only one input into the committee's overall decision-making process. Many of our clients operate in low-yield, high-growth industries where some weight of options may continue to make sense. We advise our clients to consider business strategy before making a decision on options. I'll next pass it on to my colleague, Rachel Lee, who will cover off trends in Say on Pay.
Great, thanks, Matt. Good morning, everyone. For this part of the briefing, I'll be providing an update on the current Say on Pay proxy season in Canada and the US. So it's been a really interesting year for Say on Pay in Canada, particularly for those of us who read compensation updates for fun. In terms of Canadian Say on Pay voting results, ISS has recommended against Say on Pay at 10 companies, of which 6 have passed. So those being Scotiabank, Tech, Celestica, GFL, Orinia, and BlackBerry, with an average support of 72% across these companies. And 4 companies have failed Say on Pay. So that's Vermilion Energy, Gildan, CI Financial, and Ryocan. These are the first failures that we've seen amongst the TSX composite since 2018. So at a high level, the average level of support amongst the TSX composite is approximately 92%, and the percentage of companies in the yellow card zone or that failed Say on Pay is slightly greater than in the past 3 years. Next slide, please. In terms of US Say on Pay results, approximately 70% of companies in the Russell 3000, which have reported Say on Pay results to date, have passed and received approximately 90% support on average. Generally, we're seeing that vote outcomes amongst the S&P 500 is lower overall compared to the Russell 3000, which is an interesting observation because it is usually the opposite. ISS recommended a vote against Say on Pay at 11% of the Russell 3000 companies, for which we have results so far. And of that, approximately 3% or 61 companies have failed Say on Pay. A few notable failures include AT&T, IBM, Walgreens, General Electric, Starbucks, Intel, and Xerox. Next slide, please. So what does the data tell us? Generally, we're seeing somewhat lower Say on Pay vote outcomes this year, and this could possibly be as a result of actions taken in response to the COVID-19 impacts on companies. And in our view, you almost have to work on it to fail Say on Pay, particularly in Canada. And from our experience, it's generally a combination of poor performance, increasing compensation, and undertaking some other action that is viewed negatively by stakeholders, which together will culminate in a Say on Pay failure. Our analysis concludes that companies which failed Say on Pay had some combination of the following commonalities. So a pay performance disconnect as a starting point under the ISS quantitative test, a grant of some form of special incentive award, adjustments to short-term incentive metrics or targets, paying of discretionary bonuses, CEO transitions accompanied by significant severance or other compensation, and adjustments to in-flight long-term incentives. And based on our review, other factors that led to an ISS against recommendation on Say on Pay, but not necessarily a failure, included lack of performance-based long-term incentives, inadequate disclosure of incentive plan targets, setting targets lower than prior year's actual results, awarding guaranteed compensation, and having a peer group viewed by ISS as being aspirational. And interestingly, these are not new or COVID-19 based factors. As I mentioned, vote recommendations are not driven by a single egregious pay practice. They tend to reflect a combination of a few factors taken together. And based on our observations, this to some extent is consistent with ISS's methodology that once they've decided to recommend against Say on Pay at a company, they tend to throw the entire kitchen sink into the analysis. I'll now hand it off to my colleague, Andrew Stansel, who will present on resilient incentive designs that held up during the pandemic.
Thank you, Rachel. Hello, everyone. For this part of our briefing, I'll provide some key principles and perspectives on developing resilient incentive programs. I'll first start with a summary of design features that hold up to difficult situations as demonstrated by COVID-19 last year. Then I'll provide some key program design and process principles against which you can benchmark your current practices and identify opportunities for change to create more resilient incentive programs. So let's start by looking at what holds up to difficult situations. A few minutes ago, Matt highlighted 2021 incentive design actions that were driven largely by the challenges created by the pandemic. Some of these actions reflect movement towards specific plan features like new or increased weighting on relative TSR. But it wasn't just some of these specific features that held up, but there were also some overall structures and processes that held up well to the pandemic. These are listed on this slide. We really got to see some of these tested last year with COVID-19. For example, well-balanced programs with a long-term focus fared very well. Features of these programs included heavier weighting to long-term pay, a balanced scorecard approach to the annual incentive, and a portfolio approach to long-term incentives with multiple measures in the performance plan. Relative TSR plans fared very well for several reasons. First, it's an all-encompassing and objective performance measure, and the relative feature auto-corrects for macro-level factors and doesn't require long-term goal setting. However, relative TSR plans did shine a spotlight on performance peer groups and the need to recheck these peers for continued appropriateness. It became really clear that peer groups should include companies subject to similar macroeconomic factors. And a great example of this is in the retail sector with the different impact of COVID-19 on traditional versus modern retail versus food retail. Performance-focused plans that aligned executives with shareholder experiences fared well, and discretionary adjustments to outcomes based on holistic assessments with symmetry, guardrails on affordability, and robust disclosures generally withstood scrutiny from investors, employees, and stakeholders. On the flip side, there were a few incentive features that really did not fare well against COVID-19. Three examples are incentive plans with a single or few metrics, and especially those with 100% financial goals. Incentive programs with significant overlap of financial and operational measures in both the annual and long-term plans, and then measures with goals denominated in dollars as opposed to ratios, like a margin goal, which fared much better. So based on what we saw hold up to the pandemic and what did not, we do expect to see a few key shifts in practices that support more resilient designs. And some of these will be more use of relative TSR, less pay based on absolute financial measures, and more based on other indicators. And one example here is ESG as an indicator, which my colleague Andrew will talk about shortly. Adoption of a balanced scorecard approach in the long-term incentive plan, so mirroring what is done in many short-term incentive plans, and ultimately more use of discretion. Okay, let's shift to ways to create resilient incentive programs. There are several principles and perspectives that compensation committees and companies can consider when designing resilient incentive programs. So in terms of these program features, it all starts with the strategy. An effective business strategy or an effective strategy delivers on shareholder value while preparing and advancing the long-term changes to the organization. It's key to ensure that this business strategy is reflected in the incentive programs. Aim for well-balanced frameworks, both in terms of pay mix and measures. For annual incentives, consider a balanced scorecard approach with a mix of financial, operational, strategic, qualitative measures, and an individual component. For LTI, consider multiple vehicles, and for the performance plan, adoption of a scorecard approach that includes the addition of strategic qualitative measures. Think about replacing features that drive short-term behavior with longer-term design features. One obvious area is the time horizon of vesting and performance periods. Flexibility. Strategic business plans change to accommodate changing environment and economics and geopolitics and social norms. Incentive programs ideally act as a catalyst for these business plans. Think about building flexibility into the program to allow real-time changes to plans and programs to ensure they keep pace with these evolving strategies and business circumstances. Consider how incentive plans can reward for appropriate and agile responses to atypical risks. This will likely require modifiers and/or adjusters coupled with discretion. Assess the performance linkage of the incentive program. Really distilled to its essential elements, pay for performance is comprised of 4 distinct principles or questions. Is there sufficient mix of at-risk pay and an appropriate mix of short-term versus long-term incentives? Do the performance measures demonstrate linkage to shareholder value? Are the performance goals set with sufficient stretch? And what's the degree of alignment between realized pay and actual performance results? All of these features may result in more long-term pay for performance and less short-term alignment. Now let's look at some processes. So part of the construction of a resilient incentive program are processes. Incentive design should be stress tested in advance for operation in extreme conditions. This can really highlight design issues that were not previously considered, so that alternative scenarios can be considered when faced with the unexpected. Think about how programs will function should unforeseen events occur. Will contingencies be in place? As the committee discussed how, when, and why it might need to use discretion in the program. And I'll speak more on discretion shortly. And then finally, it's really important that committee process is effective. We provide our take on 10 key elements of a great committee process on our website, but there are 3 that are particularly relevant to resilient designs that I just want to call out at this moment. Open and direct communication between the committee chair, the HR team, the CEO, and compensation advisors is critical in making design decisions. It builds a relationship of trust and collaboration that allows management and committees to raise concerns for discussion and to work towards appropriate outcomes. First and foremost, do what's right for the business, strategy, and the current challenges. Understand, but don't be a slave to competitive practice, market norms, and proxy advisor expectations. And finally, seek expert advice to provide perspectives and contents on areas that warrant more in-depth review. So moving to discretion. Ultimately, there's no design parameters that can entirely ensure incentive programs cover all unforeseen risks or difficult situations. Many committees are willing to consider both principled adjustments and the exercise of discretion in assessment of incentive payouts. And many companies and committees already have some formal principles for adjustments to incentive plans for specific topics like M&A activity, foreign exchange, or other events that are clearly outside the scope of management's control. Best practice is to adopt formal principles in advance to determine the types of adjustments that the committee is prepared to consider in determining incentive payouts, so that management's and the board's expectations are aligned and to avoid surprises. Generally, these principles are designed to provide consistency, year-over-year symmetry, neither punish nor reward management for unexpected events that are outside their control. Adjustment principles are generally a good starting point for considering incentive payouts, but for many companies, these stated principles may not adequately address a black swan event like the pandemic, and won't take you where you need to go in a really unusual circumstance. Discretion may be required to provide incentive payouts that reasonably reflect management's efforts and achievements. I talked about this a little bit earlier, but the application of discretion should be influenced by a multitude of factors and applied thoughtfully based on specific facts and circumstances. And it should include guardrails reflecting affordability and shareholder and stakeholder alignment. In the end, it should be clearly communicated with the disclosure of the board's process, decision process, and rationale for the changes. Just as an aside, we generally saw companies that dealt with discretion through disciplined adjustments rather than outright discretion fare better with proxy advisors this past year. So to wrap up, incentive programs built with these features and processes in mind, with added flexibility and the use of discretion to provide incentive responses that go beyond simple accommodation to doing what's right for the organization, will result in more resilient programs that stand the test of time. Thank you. I'll now turn the session over to my colleague, Andrew.
Thanks, Andrew. And good morning, everybody. Matt Cito and I are going to speak for a few minutes about one of the hottest topics we have in executive compensation right now. That's environmental, social, and governance factors, and whether and how and what form companies should begin paying for ESG in their incentive compensation programs. I'll start with a sort of recap of where the landscape looks right now, and then I'll turn over to Matt with some market data. So as noted, this is probably the hottest of hot topics we have right now. We spent a fair amount of time last year talking with companies we work with about how are we going to react to COVID. And as COVID receded as an issue during the course of 2020, ESG took its place. And I think it's fair to say that ESG is not going away anytime soon. This is an area that's moving extremely fast. It'll be interesting to look back in about 6 months and see if anything we say today has any relevance at that point or not. But we'll try and sketch out where we think things stand for ESG at many companies, and then what the future may hold. It's worth pausing for a second, asking ourselves, so how did we get here, and what made ESG so prominent so quickly? And I think the answer to that depends a bit on what yardstick you're using. There are many who will tie the usage of ESG as a potential compensation metric back to when a group called the Business Roundtable reimagined the purpose of a corporation as being stakeholder focused rather than exclusively shareholder focused. That happened about 2-3 years ago. So that might be one starting point. By another yardstick, there are some companies in extractive industries, for example, that have been paying for ESG for a long time. They just haven't called it that. And that's companies that have recognized the need for a social license to operate, and typically have focused on paying for performance with environmental or some social like safety criteria. And that's been a story that has happened for years, or in some cases even decades. And then the third and probably most salient yardstick right now is, with COVID exposing a large number of societal tensions and pressures, that's what's given, or that's what's acted as the accelerant, if you like, for many ESG criteria that many companies are now considering working into their plans. Here's where we think things stand. Many companies are now making very fulsome disclosures about various E, S, or G criteria that they care about and that they pay attention to. So many companies, for example, issuing their inaugural corporate sustainability reports in the last year or so. It's probably fair to say that some companies hope that that's where they would be able to stop and they could talk about the importance of ESG as an issue without necessarily paying for it. The second place we see this is a good faith, I'd say, effort on the part of many companies to take the things that they were already doing that are recognizably ESG metrics and describe them as such. So this is an example of an energy company, for example, that's been paying for environmental improvement for some time, and now putting that under the header of ESG, and that's a fair thing to do because that's where it belongs. And then we come to the probably the bleeding edge of experimentation with many companies now saying, we feel like we need to pay for ESG performance in some fashion. We're hearing about this a lot. We're not sure what to do, and we're not sure if we have the right metrics, but we're going to take a few tentative steps and design ESG indicators into our incentive compensation plans, but we're pretty sure it's going to change. So not durable designs at this point. And that leads to the fourth point on the left side of this page, where that is taking place, ESG tends to fall as one indicator among many with a low weight or maybe no formal weight at all within the incentive compensation program, part of a scorecard. And that's reflective of the tentative nature and the fact that it's very early days for many companies. So that's probably a fair description of where things stand right now. Now, if we take out our crystal ball and shine it up a little bit, here's where we think things may be going. Large investors have been a prime mover. So we need to go back one. Thank you. Large investors have been a prime mover on asking companies to pay attention to ESG for some time. The BlackRocks, the Vanguards, the big investors in the United States. And if your investor base includes some of the large European investors, it's probably fair to say you're going to hear about this from them sooner than if it was an exclusively North American investor base. We'll probably see companies allocating more formal weights within their incentive comp programs to ESG criteria. and we'll probably see an evolution towards more precise numeric quantitative criteria. Another trend that we'll likely see, although quite early days, not a lot of installed practice yet, is if you think about the timeframes over which progress on many of these indicators is measured, it's not usually an annual cycle. And so the natural question follows, are we measuring this in the right place? Should we be measuring it perhaps in our long-term performance share unit plan, not in the annual plan? That trend will probably see take further wing in the future. And as noted, the flip side of companies planning to experiment and knowing that their design is not durable, as we'll see some whipsawing back and forth as ideas are tried. Those that work will stay, those that don't will get pulled back, and something else will be tried. Worth noting before we hand it off, this has really been an initiative led by the market, or if you like, the public in general, by governance norms and expectations, and by shareholders. This isn't really a place where the proxy advisors have had an outsized voice in trying to drive design decisions. The proxy advisors certainly care about ESG, but thus far they've been focused more on the governance aspects of ESG, for example, how boards of directors of companies are constituted, less on ESG as a compensation issue. So I'll turn it over to Matt, who will take us through some market practice now.
Thanks very much, Andrew. Based on a Meridian study of about half of the S&P 500, close to half of companies disclose the inclusion of an ESG metric in the annual incentive plan. The uptake in the long-term plans, at least based on the market data, continues to be a minority practice. We think this is primarily a result of goal-setting challenges, the qualitative nature of ESG goals, and the potential accounting and disclosure issues that come with ESG goals, particularly in the United States. Still, as Andrew mentioned, we think this is one of the fastest moving areas as more companies consider multi-year ESG strategies that require multi-year incentive goals. We therefore anticipate more rapid adoption in this area. Next page, please. So I've covered off the what, now I'll dig into the how. How are companies incentivizing managers for ESG initiatives? There are really three broad categories. It's in the name of ESG: environmental, social, and governance. We most commonly see social metrics being implemented with a strong focus on diversity and inclusion, workforce health and safety. But in the environmental, we're seeing carbon and climate incentive metrics, and in governance, we're seeing some cybersecurity metrics. Getting into the weeds a bit, where companies did disclose an ESG metric weighting, rather than ESG goals tied either into strategic or individual scorecards without a formal weighting, the most typical weight in the overall plan was anywhere between 10 and 20%. A common example would be a safety metric in a safety-sensitive business like energy and mining that's weighted 15% of the overall scorecard. The weighting is largely dependent on the overall importance of that incentive metric to the overall business strategy of the firm. I'd now like to pass it on back to Andrew to talk a little bit more philosophically through ESG strategy as it relates to incentive compensation and the necessary trade-offs.
Thanks back, Matt. So we thought we'd try and draw out some of the trade-offs with ESG design. Let's assume for the moment you want to pay for ESG. Here are some considerations that go into doing it. It's not possible, or at least we would not advise, trying to pay for every ESG indicator under the sun. And the way in which you pay for it, the how, there's some pretty profound differences there as we look through this plan. So the left side of these diagrams is probably more indicative of the conservative path, the path that many companies are taking so far. The right side, more indicative of other potential design choices. And some of these left and right would go together better than others. I'll try and talk through them. So first of all, as noted, will you pay for ESG in the annual plan over a one-year cycle or in the long-term plan? Annual plan has the merit of more companies are doing that, so there'll be more design inspiration out there. Long-term plan has the merit of probably being better matched to true natural performance periods with the trade-offs of there are some technical challenges around accounting, particularly for companies that use US accounting standards. And there's just a normative aspect where we don't see ESG indicators in long-term plans, which have tended historically to be exclusively financial metrics and or market metrics, share price-based metrics like relative TSR. Do you want to have your ESG indicators in a bit of a basket that you could evaluate performance on them as several indicators taken in total? Or do you want to have specific indicators with specific weights? And probably this one points to, it's not possible to pay for every ESG indicator that you might. And so choosing which ones matter for your business could be implied by putting a specific weight on one. Do you want to make the measurement more qualitative in nature? Or you might say, do you want to require that judgment over performance evaluation be incorporated? Or do you want to make it more precise, use numbers where possible, perhaps not measure performance as well, but definitely measure it more precisely? And given that many ESG indicators don't lend themselves very well to numeric evaluation, at least right now, this will be another place where companies will need to think carefully about what it is they're trying to measure. Do you want a process focus or an outcome focus? And if we use the example of safety from extractive industries, the trade-offs are noted here. Process focused things like leading safety indicators hopefully build up the culture of safety at a company. It takes longer and it is unsatisfying to people who are very focused on, we need to make our organization as safe as possible. Outcome focus, saying we're going to look at how many incidents, safety incidents we have and pay if that number goes down. That will definitely get you what you pay for, but it comes with some pitfalls of its own. Notably, if you're a company that says when we have safety incidents, we're going to dock people's pay, you may find magically you have fewer safety incidents that get reported, even if you're not actually having fewer safety incidents. So pitfalls, more profound pitfalls on that side. And lastly, sort of a cousin of qualitative versus quantitative measurement. Do you want to measure in terms of direction or in terms of precise magnitude? So directional improvement. We have a certain number of employees of a certain demographic cohort. We want that number to go up, but we're not going to specify by how much. Precise measurement. We want that number to go up by, let's say, 10%. And that implies that 10% is a vetted, reasonable, everybody agrees that that's the right coefficient kind of number to it. So these are all the trade-offs you have to focus on if you're thinking about paying for ESG in your incentive comp plan. Can we go on more? To that point, we figured it would be, there'd probably be a fair amount of interest in how some companies, of the few that are out there so far that are paying for ESG in a long-term context, how are they doing it? And an important case study on this comes from the United States. This is Prudential Insurance. It's one of the largest insurance companies in the world. And this is a company that's taken up ESG criteria for financial services, an important set of criteria, namely diversity and inclusion, for some years now. And a recap of their most recent design as disclosed is noted on this page. I should note Prudential is not a Meridian client, so this information is what we could gather from what has been disclosed. There's no inside baseball going on here. It represents a good balance. You have, starting with paying for the financials, the shareholder focus, that yields an initial payout on a Prudential performance share. And then that payout is multiplied through a modifier that itself is based on 5 additional diversity and inclusion criteria, and they're listed on this page. So this appears to be a case where they're measuring at a high enough level of aggregation that they're not being too specific and therefore potentially driving inferior behaviors in terms of how do we make our workforce more diverse. But they've also grappled with and come up with the coefficients, the growth rates that they're seeking, 10%, 25%, as the case may be, for these various criteria. And likely by doing so, they've been able to avoid some of the technical challenges that a company using US GAAP might otherwise encounter. So this is a good example of a company that's evidently gone through those trade-offs on the prior screen, come up with a workable design. It doesn't have a huge impact on the outcome for performance share recipients, but it probably has enough of an impact that they'll pay attention to what these goals are and try and do something about them. Which then brings us to a few considerations if you're not sure about whether paying for ESG is the right thing for you and your company. So the first question, will you end up paying for ESG? The answer is probably yes. We do encounter some companies that say we're going to talk about the way that we work on ESG without paying for it. But quite frankly, many compensation committees are going to be under considerable pressure to do something more deliberate about paying for ESG, and that will be hard pressure to resist. Should you focus on the ESG metrics that matter for your business? Unequivocally, yes. I should note here, I wouldn't say it's necessary for every company have an E and an S and a G in their incentive compensation program. It suffices, and I'd say it's a requirement that you focus on the ones that matter most for you, and ideally ones that have an impact on the business, on the bottom line, or otherwise on the financials. We're already seeing sectors specialize in some ways. Financial services are focusing right now a great deal on diversity and inclusion, customer engagement, customer satisfaction, employee engagement. Other industries are focused more on the E, and most commonly these days, the trend is with greenhouse gas emissions and climate change. Can you measure it? It might be a great metric, but if there's no method of measuring it, then you need to get comfortable with a great deal of judgment over people's pay. So you might have the perfect pristine metric, but if it's not easily measured, then it might need to go by the wayside anyway. Should it apply to everyone? Depends, is our stock consultant answer. But probably right now for many companies, the answer is not everyone, no. That below some level, you should turn the ESG criteria off and pay based on more traditional metrics. And then we note the conservative path right now, which really does look like the installed practice page at the beginning of this presentation, keeping it within the annual plan, keeping it as one metric among many, using qualitative measurement, which really requires judgment be inserted right in, and focusing more on processes and practices, less on specific outcomes. And with that, I'll look forward to the questions at the end of the discussion, and I will hand it off to Chris. I think you're next.
Thank you very much. The last 2 years have been challenging for businesses. They've also been challenging for almost all of us on a personal level. But I will say from a purely selfish perspective that they have been fascinating from an incentive design perspective. The unusual circumstances that we have seen have really increased the creativity in incentive design, and we've been seeing a real move to homogenization and to similar plans across the board. And we're seeing a whole lot more thought and time spent on really very bespoke and very strategically linked incentive designs. So I get to wrap up our session by talking about something which I find completely fascinating. If we can go to the next slide, please. I guess we start with the principle that incentives should be based on and designed to support strategy. Where this leads us, though, is that when business circumstances are unusual, your incentive design should link with that and may also need to be different from what you normally do. So we start with strategy, and we really ask ourselves two key questions: the what and the when. And the what is, what are our key strategic initiatives? What is it we need to accomplish? And the when is, what is the expected timing? Is this something that needs to happen in the course of months or a year, or is this something that's going to happen over multiple periods? The answers to those questions on strategy really drive both the design structure and the metrics that we choose. In terms of the design structure, the first key question, and it's really a when question, is do we choose an annual award or do we choose a long-term award? Obviously, to drive immediate behavior design changes, we want to focus on an annual award, but to create alignment with a longer-term shift in what's going on in the business, we may use a long-term award. The next question, and this is really a critical question, is whether we can do something special that's within the normal plan. So can we change metrics? Can we change the weighting? Can we do something within the normal plan that helps us drive the behavior and the strategic initiatives we're trying to drive? Or do we really need to do something special? And special almost always means, at least if you're giving something to your named executive officers, that you're going to attract a lot of scrutiny. In terms of the metrics, strategy obviously determines what the metrics should be, because the metrics are supporting the what is it we're trying to do. We try to have measures that are SMART, which is specific, measurable, attainable, reasonable, and time bounded. That doesn't mean that they always have to be directly quantitative, but you need to know what success looks like and how to measure it. And then we focus in terms of our choice of metrics on what are the things that drive the key behaviors that we need, and what are the metrics that create necessary alignment with stakeholders. As we go through this process, we also need to think about this from a couple of other perspectives. The first one is we need to make sure that we have alignment. And alignment used to just mean alignment with shareholder experience, but it ought to mean alignment with shareholder experience, alignment with what is critical for the strategy, alignment with a broader stakeholder community. These kinds of plans and special awards should provide the opportunity for creation of wealth for executives when that wealth creation is aligned with and proportionate to what we see from a shareholder experience perspective. And of course, special incentives can be a key vehicle to attract and retain your leaders. Next slide, please. So I'm going to talk a little bit about incentive designs during transition periods, and I really divide those up into three buckets. The first bucket is the significant acquisition or divestiture, so the M&A bucket. The second bucket is typically a less happy bucket to be in, but it is the turnaround or recovery bucket. And then the third is what I'm calling the fundamental strategic shift. This may be a movement from a bricks and mortar business to a significant omni-channel digital business, where you really need to do something different to kickstart changes in the business. All of these bespoke or special incentive designs come with some competing goals. On the sort of executive side of this, we're really focused on making sure that we're retaining the key leaders, that their compensation is competitive, and that we are providing rewards for what it is we are asking the management team to do. But you have to balance that against what's going on really from an investor perspective. And that is partly, how will your investors see what it is you're doing? How are they likely to respond to it? Is it going to look fair, measured, and appropriate from an investor perspective? With special designs, more than any other place in the compensation spectrum, you need to be able to step back and bring that sort of higher level or holistic perspective to what it is you're doing. And then the sort of thorny question that comes up a lot in committee discussions is, are we providing this kind of a special award for something that's truly extra, or is it really part of the job? And this has to do a little bit with the expectations of an executive. A significant acquisition is probably part of your CEO's day job. Fundamental strategic shifts may be part of the CEO's day job, but they may not be part of the day job of somebody who is that next level down in the organization. I was going to just talk briefly about 3 examples of special awards that we see in each of these circumstances. The first one is something that we've seen described as a synergy PSU. It's typically an award that sits on top of the regular long-term incentive award. Typically, it's 100% performance focused, and it's designed to pay for achievement of the synergies that are critical to the transaction being successful. And that really means making sure that you've harmonized the 2 companies, that you've taken out the costs that you were expecting to take out, and that you have the synergistic benefits so that your acquisition was designed to deliver. These kinds of incentives can be really important because transactions that look great on paper may fail if you don't actually achieve the benefits that they're designed to achieve. The second is cash-based long-term incentive awards. I mean, typically, we like long-term awards to be based on company equity because that really helps ensure that there is a close link between company performance and what executives receive at the end of the day. The one circumstance where you may see cash-based awards is in the turnaround or recovery scenario. And that's really because we reach a point where there is so little confidence in the value of the underlying equity that in order to achieve any of your objectives, you need to provide cash-based awards. And when we talk about them as cash-based awards, they're obviously still significantly performance contingent. It's just that they don't have that additional toggle, which is increasing or decrease in value based on share price. And then lastly, something that we've seen a fair bit of in the last little while is a premium priced option. And these things can be wonderful when we're talking about supporting a fundamental strategic shift. Again, these kinds of awards, premium priced options, tend to sit on top of the regular long-term incentive. But a premium priced option would say, for example, if the share price right now is $10, the strike price for this option may be $15. So before you get any value at all, you have to increase the share price to $15. And when you get to $15, your option is still worth $0. When you get to $16, your option is worth $1. And so these are very highly leveraged, very, very focused on share price, and where you've got a fundamental strategic shift underway that's going to dramatically change the multiple for the business. These can be a wonderful tool to use. They're also a tool that we'll come to disclosure later, but they are a tool that can be the subject of some fairly compelling disclosure. Next slide, please. Most of these kinds of unusual awards find themselves into the bucket of special awards. So they either sit on top of the regular plan or they replace a part of the regular plan. Where they sit on top of a regular plan, the concern here, not the concern. If you have an award that's sitting on top of your regular long-term incentive plan, expect that that will raise red flags with proxy advisors. And I've kind of divided into 3 categories here. What makes a special award okay? What makes a special award problematic? And what makes a special award so bad that you're likely to fail, say, on pay? So when you're setting up a special award, if it's a focused reward for achieving strategic performance, critical initiatives, aligned with share price improvement, if it's something that you're using to attract and retain critical talent in difficult circumstances, and where you've got a compelling disclosable business rationale for what you are doing and why you're making a special award and why you're providing compensation on top of regular compensation, the reaction from the proxy advisors, all other things being, in the acceptable range, is that they are likely to criticize it. They're not likely to recommend against, say, on pay. Once we get into the bad section, paying really for something that should be part of an executive's day job. So paying for things that you would already expect them to be doing, Awards that have a focus that is primarily on retention rather than performance, or awards that are less than 50% performance contingent. And remember that plain vanilla options, even though they only have value of share price increases, those are treated as not performance contingent by the proxy advisors. So if you have features of your special award that are in the bad category, you should expect from the proxy advisors to get a recommendation against say on pay, but are likely with good shareholder engagement to be able to pass say on pay unless you have a history of problematic pay practices. And when you get into that last category, you're making special awards multiple years in a row. You are making awards that you describe as being awards that are restoring the value that your executives have lost due to share price depreciation, or where you're making significant rewards to retiring executives. You expect, of course, a proxy advisor recommendation against say on pay, but these are the kinds of things that we see in those companies that actually fail say on pay. Next slide, please. So when we talk about disclosure, the first thing that we talk about when we're talking about special awards is decide on your structure, figure out what it is you think you want to do, and then test how that is going to play by drafting the disclosure before you even make a decision. And then once you are making the disclosure, understand that you are doing something unusual, different, that really is outside the lines, and make sure that you are describing that compelling business rationale. Some of the things that we've done for our clients include demonstrating that the particular award, in example, one, a premium priced option, only pays out if shareholders receive a very significant benefit first. Or explaining how challenging the performance criteria are. So maybe showing a historical performance and what is really required to achieve even a threshold payout that's significantly higher than that. This concludes the formal part of our presentation, and I'm going to hand it back to Andrew Conradi, and he is going to lead us through some questions and answers.
Thanks, Chris. And thank you to everyone. Fascinating stuff all around. It's always interesting to get to sit back and watch the presentation as it unfolds. Before we move into the Q&As that we've collected over the course of the session so far, just a quick housekeeping item. We will be providing a copy of the presentation after we've concluded, as well as a link to a recording of the session. We think we add a fair bit of extra content verbally as we go through the slides, so it may be worth availing yourselves of that recorded option as well if you'd like to take this information back with you and share it with anyone else at your organization. That being said, I'm going to hop right into a few questions and provide some answers, or collectively provide some answers. We are going to exercise our prerogative to group a few of the similar questions together so that we're as efficient as we can be. I'm going to go through these actually in the order that they appeared in our presentation and direct them to the folks that were covering those areas of the content that generated the queries. So first up is going to be for Matt, and it sounds like one of the more common actions that companies took for 2021 annual incentive designs after the widening of goal ranges was the introduction of non-financial metrics. People are interested if we can describe a little bit more about what was contributing to those non-financial metrics.
Sure. Thanks, Andrew, and thanks for the question. I think we touched on the use of non-financial metrics a little bit actually later in the presentation with Andrew McLaurin's part on ESG. The one thing I'll say is companies really evaluated business strategy and looked at the metrics that might in particular help them in a recovery post-COVID. So these really ranged from the disposition of non-core operating assets to employee wellness and satisfaction through the pandemic to even strategic initiatives like accelerating work from home strategies and digital adoption that came with COVID. Companies, like I said, also looked at ESG metrics where those made sense. 2020 and 2021 was really a combined pressure of increased focus on ESG, is what I'd like to call it, while trying to relieve goal setting pressure on financial metrics in the plan. So the increase in the non-financial metrics, because those financial metrics tended to be a little bit more volatile, uncertain with goal setting. And the combined pressures therefore shone a pretty big spotlight on ESG as an alternative. The key, I think, and this was voiced over later in the presentation in terms of the principles of actually including these non-financial metrics, was thinking about SMART goals: specific, measurable, time-bound. Just because it's not a financial metric and it's a strategic or an individual metric doesn't mean you can't attach some kind of performance measurement criteria to it. So even if you couldn't set numeric goals, setting progress against a goal was a good way to diversify the annual plan and make it a little bit more resilient, the overall annual plan in an uncertain year, something Chris touched on when she was talking about special designs.
Fantastic. Thank you, Matt. That is really interesting to your point about ESG. And while obviously the ESG trend does predate the pandemic as well as unfolding in parallel to it, but curious to see if the forced or the adoption out of necessity of all these non-financial measures basically creates an environment where we're suddenly more comfortable with implementing those as part of incentive plans. As we touched on earlier, lots remains to be seen as things unfold. Turning briefly to Say on Pay, once again, I'm going to direct this one to Rachel. We mentioned that we're seeing a slight uptick in against recommendations by proxy advisors over the past few years. What are some of the strategies that we'd recommend to address a negative recommendation or potentially even a Say on Pay failure?
Thanks, Andrew. So, it's interesting. The degree of work or actions I think to be undertaken will depend on the severity of the vote outcome. We frequently work with clients to formulate strategies to improve Say on Pay, and a few suggestions are shareholder and proxy advisor outreach and engagement. So set a strategy, stay on track, and issue a press release stating all the actions that you will be taking in the following year to address the concerns. Review, actions and elements which led to the negative recommendation in the first place, and whether changes could be made to address the compensation program to address those concerns, or consider if there are other actions which are low-hanging fruit, which the company can undertake that would be viewed favorably when proxy advisors view the compensation program holistically. So, for example, review of peer group and benchmarking and increasing shareholder ownership requirements. Thirdly, a robust review of proxy disclosure to ensure that any actions or elements which make sense for the business but may be viewed unfavorably are communicated clearly with the right narrative, and also consider adding a letter from the compensation committee chair at the beginning of the CDNA, just to address any of the concerns from the proxy advisors. And I think those would be a few suggestions and a good starting point to kick off discussions to address Say on Pay concerns.
Fantastic. Those are all good strategies, and anchored with our universal caveat that there are some commonalities in the factors that we're dealing with, but when it comes to positioning your messaging your own facts and circumstances, it is a bespoke exercise and worth delving into individually. I have a question here that deals more with the incentive resiliency, and so I'm going to point that to Andrew Stamsel. We're curious, one of the ways in which we might improve the resiliency of a plan is to have more moderated payouts on the upside and the downside. How do we manage the tension between that kind of change and the desire to keep a strong pay for performance focus? Are those competing concerns?
Yeah, thanks, Andrew. That's a great question, and I mean, it's always challenging to manage some of these trade-offs in incentive designs. Yeah, clearly there are a bunch of features that are going to, there are a bunch of features for resilient incentive programs that are going to moderate payouts. Your balanced scorecard approach with multiple measures, target setting approaches with broader ranges and shallower leverage curves, et cetera. But maybe the first point I want to make is I would argue that these do not necessarily weaken the pay for performance focus, but rather just decrease year-to-year volatility in the payouts. And I talked a little bit about the pay for performance link earlier in my presentation, where I highlighted those four kind of essential principles to ensuring that you've got a link in pay for performance. That had to do with the mix, the at-risk mix, do the measures align with your strategy? Is there a link to creating shareholder value? And have you set your goals with stretch? And do you test the actual alignment of pay outcomes in the context of actual performance results? So I think going through that process would probably be helpful in managing this issue and coming up with some kind of reasonable balance. The other thing is, this is probably where you want to ensure that you've got flexibility in the design. And that's probably some kind of combination of modifiers, adjusters, and discretion, so that you can actually ratchet payouts up or down to reflect performance, maybe more extreme performance or uncertain or performance, in uncertain situations. Where it's appropriate, where you might otherwise have very moderated payouts because of the design. I'll pause there and see if any of my colleagues have any comments to add.
Hearing none, I think that must have been thorough, Andrew. That certainly addressed the question for me, and to those who asked it. If you have further detailed information you'd like on that, I'm sure Andrew and everyone would be happy to help dive into that one-on-one with you. I have another question here, this time dealing with ESG, and a bit of a double-barreled one. I'm going to point this to Andrew McElhern and to all of my colleagues that subsequently, if anyone wants to chime in, of course. Do we think that there's going to be an investor backlash against ESG metrics in a few years? And a parallel question, are there features that we could be thinking about now that might help moderate the impact of that potential future backlash if we are concerned that might be in the cards?
We think there'll be an investor backlash against ESG as a compensable metric. It's probably fair to say there'll be some push-pull as companies experiment and some of those experiments fail, which is probably inevitable. We may see some investors say, not necessarily ESG is the wrong criteria, but more like you're doing it wrong. And we may see, we've been talking about ESG the last 12, 18 months or so in an environment of fairly robust performance for the capital markets. And there is a philosophical question there about, is the sort of stakeholder model of capitalism and the purpose of the corporation the right one? And there may be some investors who say, let's revert back to a more traditional shareholder focus. And that may translate to more low-key emphasis on ESG in the future compared to now. By contrast, though, when you look at some of the really big institutional investors who kick this thing off, BlackRock comes to mind. I think it's unlikely that BlackRock will simply say, this whole concept, this project was misconceived and therefore it should be abandoned. But it's also true that BlackRock has not been very fast in saying we want ESG to become a compensable metric, or we want ESG criteria to become a series of compensable metrics. So they're moving slowly enough at the big institutional investor level that probably they won't need to have a significant reversion back through time, at least as I think about it.
All right, makes good sense to me. Having come to the end of our initial set of questions there, I think it's incumbent on me to once again say thank you for everyone's participation and for your time. We appreciate the chance to get in front of everyone and give you this update every year or so. And we invite you to reach out if any questions do occur to you, in the future or at any time about any of these matters. We're standing by to help you navigate these processes, and we look forward to hearing from you. Thank you again.